Good morning, everyone. Lee Lowell here from smartoptionseller.com. Today is Saturday, June 6, 2020. Time for another edition of your Saturday Synopsis, where I check out the stock charts, see what the market has done over the past week, and see what may be coming for the week ahead. I do this every week, and I also like to give you some good options information, some educational content. So I hope everyone enjoys these weekly videos. So let's open up the charts, see what the market has done over the past week so we can possibly see what may be happening going forward. Once again, we bring up the chart of the SPY. It's the ETF, which tracks the S&P 500, which is basically a general barometer of the market as a whole. As we've been talking about, we key in on this 200-day moving average on the charts because that is basically the line in the sand that all traders use to signify either major support or major resistance. SPY, as I noted last weekend, finally broke above the 200-day moving average around the $300 level mark. Okay, so right here, 200-day moving average was hovering right around 300. And at the end of last week, it had popped above it, had a couple days worth of movement above the 200-day moving average. So now, instead of it being resistance and knocking the market back down, it has now become support, meaning that if the market falls, the $300 level will act as major support. The other thing we noted is that once a market moves convincingly through such a major moving average such as this 200-day line, it continues to go in the direction of the breakout. So obviously we see last week it moved above it and just continued to skyrocket. This market is incredibly strong. And yesterday, Friday, June 5th, the US came out with the unemployment numbers, and there was a lot less jobs that were lost. We actually gained jobs in the last month, and the unemployment rate fell as well. So the market took that as a great thing, just powered higher. We gapped open. Here's the gap. You can see the blank space here from the previous day's trading to the next day's trading. It's called a gap move, gapped higher, and it's just been incredibly strong. So the market wants to move up. Businesses have been opening back up. Unemployment's coming back down now. The government is backstopping everything. I mean, there's no stopping the market now. The market just wants to go up. And let's take a look at the NASDAQ, which has been the strongest of all the stock indexes. Here's the NASDAQ composite, has now tagged its all-time highs that it hit back in February. So here's just a technical indicator we have, or a technical pattern, I should say. We have what's called a double top right here. Double top can sometimes mean a long-term top is being formed and the market will back down. Don't know if that will play out yet. We're waiting to see if the NASDAQ can actually pop through here. If it does pop through here, we're off to the races again. Now, we can look at the NASDAQ futures, which pretty much leads the market. As of yesterday, the NASDAQ futures actually popped above the double top resistance. It has made a new high for the year, so that's just incredible. This is what is called a classic V-shaped bounce. And look how fast that happened. And it's popped through here. So the futures have popped through. The NASDAQ composite itself is right on that double top area. If it goes through and follows the futures market, we're just going to keep moving higher. Now, the Dow Industrials, not as strong, but finally popped through its 200-day moving average yesterday on the strong unemployment numbers in the US. So we had the 200-day moving average kind of holding it back, and it just blasted right through it. So it looks like it wants to go higher, wants to keep going higher. And back to the SPY. Same thing. It has already blasted through its 200-day moving average and continues to go higher. So I really don't see anything stopping this thing now. The market is strong. Government is backstopping everything. Unemployment numbers are coming down. Businesses are opening back up. I think the only wild card here will be any increase of the coronavirus infections, only because people are out and about now. Businesses are opening back up. People are going to beaches. People are gathering in groups. So we want to see how the social distancing, wearing masks is going to keep this thing at bay. Probably in the next few weeks, we'll get to see some numbers on the coronavirus. Hopefully, the numbers don't skyrocket. But even still, I mean, I think people around the world are learning how to deal with it, trying to keep the social distancing when they're out, wearing masks. So we're doing okay with it. So as far as the market is concerned, it just wants to keep going higher. And anyone who had gotten out down here has certainly have the FOMO, the fear of missing out. They want to get back in. Money on the sidelines is starting to get back in. So at this point, the path of least resistance is higher. The market wants to go back to up to all-time highs, and there's really nothing to keep it from doing that. So the way I see it is the market looks strong. I think it's just going to keep going up at this point. And that's the way we should play it. So if you did happen to get long and you were buying stocks on the way up, congratulations. It's been a great move. I know a lot of people who were able to get back in. Great move. So our lesson for today is a lot of people will ask me, Lee, when should I take profits? This market has gone up pretty strong very quickly. I'm afraid of another pullback. I want to protect the gains that I've made recently. And that's a great question, because when we sell put options, that's what we do here at smartoptionseller.com, is that we sell put options. We sell put option spreads, which are bullish strategies. So we certainly want to lock in profits when the time comes. So how do we do that? People ask me, Lee, when I sell a put option, how do I take my profits? How do I know when to lock in my gains? And that's a great question, because that is my lesson for today. I want to show you how, my number one rule on how and when to take gains when you are selling put options. So let's bring up the document that I wrote here. Now, when you sell a put option, what you're doing is actually the initial part of the transaction is you're actually selling a put option contract to somebody else, and that's the put option buyer. So when you sell that put option, you're getting money into your account and you're taking in the premium, and that's the price of what the option trades for. It's called the premium. So in this example, I talk about my 80% rule. This is my number one rule on how and when to take profits when you are an option seller, specifically a put option seller. What does the 80% rule mean? Well, let's look at the example here. Let's just say you have a $50 strike price put option that you've sold, and you've collected 50 cents per contract when you sold that put option. Okay? Now, the rule is, the 80% rule is that when that put option contract declines or decays in price by 80%, that is when you look to lock in your gains. What does that mean? Well, an option contract, when you sell it, what you actually want to happen is you want that option contract to get cheaper in price. That's how you will make a profit as an option seller. You sell it at one price, and then you look to buy it back at a cheaper price. That way you can lock in the gains. With the 80% rule, we want to see that put option price decline by 80% before we actually look to take profits and buy it back. Well, how do we figure that out? Well, in this case, we sold a $50 put option for 50 cents per contract. What we want to do is wait for that 50 cents to decline in value by 80%. How do we figure that out? Well, 80% times 50 cents a contract equals 40 cents a contract. When that option declines by 40 cents per contract, that is when we will lock in the gains. Well, what price will that eventually be? Well, 50 cents minus 40 cents equals 10 cents. When this put option is showing a value of 10 cents per contract in the market, that's when we would buy back the contract. We sold it for 50 cents, and now we're looking to buy it back at 10 cents. Meaning we want to capture 80% of the full profit potential. Whenever you sell an option contract, whether it's a call option or a put option, the maximum profit you'll ever make is whatever you sold the option for. In this case, we sold it for 50 cents per contract. That is the most we can ever make on the trade. If, let's just say we let the contract expire worthless, the maximum gain would be 50 cents. Okay, so that's all you can make. The 80% rule states that we want to capture 80% of that full profit potential. In this case, 40 cents per contract equals the 80% of the full profit potential. So the way we figure that out, 40 cents divided by 50%, 50 cents equals 80 cents. 80%, excuse me, I'm getting tripped up here this morning. So the 80% rule, whenever you sell an option, wait for the value to decline by 80%. In this case, sold it for 50 cents, 80% decline, would take it down by 40 cents, and now it's worth 10 cents per contract. I know I'm throwing a lot of numbers at you, but it's actually very easy to figure out. So once that option is worth 10 cents a contract, buy it back. You've locked in a 40-cent gain, which equals 80% of the full value. Now, don't confuse that with thinking that you've made 80% profit on the trade. It's not what it means. It means you've captured 80% of the full profit potential. Your actual return on the trade will have to deal with your margin requirement. And the margin requirement is something that we talk about in the Put Selling Basics ebook. Whatever your margin requirement is by your broker, that's how you figure out your return on margin. And speaking of the Put Selling Basics guide, if you go to our website, smartoptionseller.com, we've talked about it before, click on the Put Selling Basics tab up here at the top. You can download, you can get a free copy of the Put Selling Basics. I talk all about how to sell put options, talk about the 80% rule, talk about your returns on the trade, everything you need to know about selling put options. That's all we do at smartoptionseller.com. If you like more information about the things that we do, I talk about this as well. You click on the Services tab. We've got a couple newsletters that we run, and we have our one-on-one coaching. So, short video today. Wanted to talk about how to take gains, how to take profits when you sell put options. My number one rule is actually the 80% rule. That's what we call it. So, next time you've sold some put options and you're looking to take gains, don't know when to take gains, just remember the 80% rule. Wait for that option price to decline by 80%, and then you look to lock in the gains. You've captured a huge bulk of the profits, 80%. Good time to get out. You'll be glad you did. That's all for me today. I hope this has been helpful. Give me a thumbs up if you like the content on the YouTube channel. Don't forget to subscribe. You'll get a message, email notification when I post a new video. That's all for me today. Wishing you all a good weekend and a great trading week next week. This is Lee Lowell signing off.